Welcome to the monthly roundup from Kepler Trust Intelligence, where Ryan, David, and I will be covering all the news in the investment trust world over the month of January. And it's been quite the month, as investment trust fans will know. So, talking of which, Ryan, could you take us through some of the most interesting stories from the last month?
Yes, of course, Joe, and indeed it has been quite the month. With December often being a quiet month, we took a quick break, but are certainly back to it now. And one story that has dominated the newswires over the past few weeks has been Saba Capital and its founder, Bose Weinstein. Bose has rolled out an activist strategy onto the investment trust industry, targeting a series of trusts he believes have underperformed, which has led to some significant discounts in places. This is something we touched on in our previous roundup, but the situation has since developed. Bose now holds positions in around 15 to 20 trusts in total, although the big news of the last month was centred around 7 of these that have become the focus for a major campaign to requisition them. This is where he's looking to place associates on the board and in some cases take over management with his own strategy. As at the time of recording, Bose has lost 5 out of 5 votes, with shareholders rejecting all of his proposals by quite comprehensive margins in many cases. Now, being quite a sizable news stories, the details and implications have been covered extensively elsewhere, not least of all in our Market Matters podcast with Baroness Ros Altmann, which my colleague Joe will be summarising later on, so stay tuned for that. Also, the situation is still ongoing, so we will look further to providing a full roundup in the next month, as well as providing any developments. However, we believe that the whole saga has so far been a big wake-up call to the investment trust industry and has arguably been a big driver behind a number of investment trust changes. And that actually rather neatly brings us on to our next piece of news, which is the increased dividends from 2 Asia equity income trusts, being JPMorgan's Asia Growth Income, or JAGI, and Aberdeen's Asia Income Trust, or AAIF. First, alongside the publication of their annual report, JAGI announced the increase of their enhanced dividend target from 1% per quarter to 1.5%. This means the annual yield on the trust will increase from around 4% of NAV to a notional 6% of NAV, a significant jump of 50%. It's worth noting that as this dividend is based on NAV, the current wide discount of 9% means investors can actually achieve a higher yield depending on their entry point. The aim of this is to increase the attractiveness of the trust to a wider investor base, and therefore, as they come in, help narrow the discounts. This new dividend policy is subject to approval at the AGM in February, which we'll be writing an updated piece of research on the back of that meeting, which will contain all the details of the new dividend policy. Aberdeen also adopted a new enhanced dividend policy in mid-January, with a plan to pay a dividend of 6.25% of NAV based on a quarterly basis. This will come from a combination of the underlying revenue the portfolio naturally generates and will be topped up with a contribution from capital. The first dividend under this new policy is expected to be based on the first quarter of the year and be paid in around May 2025, and is expected to be a big increase on the trust's previous dividends and therefore the yields. The trust currently trades at a reasonably wide discount itself of about 8.5%, and therefore the actual yield may be a little higher than the 6.25% headline. Of course, the actual pound and pence figure may fluctuate as NAV moves around, and the dividend is based on that NAV figure, but regardless, it is an attractive headline rate for investors. In their announcement, Aberdeen also said the trust will have a new continuation vote, allowing shareholders to vote on the future of the trust every 3 years starting in 2028, which we believe is quite good shareholder governance. We believe the timing of the policy tweaks is interesting. Whilst the two trusts and the sector as a whole have traded at a discount for a little while, the fact they have both adopted very similar policies in quite a short order could indicate that they are getting ahead of any potential activist action. Either way, this increases the appeal of these Asian trusts as a source of income, in our opinion, which could help narrow the discounts as investors come in for them. Only time will tell. Now, moving on to our final bit of news, and that is on Cordiant Digital Infrastructure. This trust has recently received approval for the purchase of DCU, which is a Belgian data center business. This has helped the trust with the ongoing goal of diversifying the portfolio, whilst also increasing the allocation in the trust to data centers, arguably the area of highest growth potential. We've recently published a lot of new content on Cordiant, which enjoyed a stellar year in 2024 after the narrowing of its very wide discount, but led to a strong share price move of over 40% in the calendar year. We believe this is a great example that the impact of a narrowing discount can have on shareholder returns.
And talking of Cordiant, we also welcome Chairman Steve Marshall as a guest on our Trust in Focus podcast. Just to add that all of our podcasts can be found on the KTI website, as well as YouTube, Spotify, and Apple Podcasts. So, a couple of key takeaways from that podcast. Firstly, their focus on assets that generate good cash flow from day one. And a couple of joint ventures aside, their 100% ownership model enables them to manage risk by directing operational strategy. But Steve also spoke about the misunderstanding about so called old broadcast technologies, given their potential to deliver video content via 5G broadcasting rather than, for example, having to pay for data on your mobile phone contract, and also the huge growth potential around the rollout of data centres.
Changing topics slightly, Joe, which trusts have investors been adding to their buy lists this month?
Yes, so Scottish Mortgage took top honours once again as its growth focused portfolio seems to have recovered from its malaise to make a 25% NAV total return last year. And also, it's worth noting its discount has now narrowed to just under 10%, so quite a significant fall there. There's also been some excitement about its unquoted portfolio, which includes Elon Musk's SpaceX, amongst others. Hot on its heels was JPMorgan Global Growth and Income, or JGGI, which has also been in our top 5 on a regular basis over the last few months, and it's a consistent outperformer in the global equity income sector. Otherwise, investors put their faith in global trusts, so we saw F&C and Alliance Whittam being bought, and also some exposure to renewable energy via Greencoat UK Wind, which is currently trading on a dividend yield of almost 9% from its portfolio of wind farms. Now, moving on to the results scene, we had some from BRIG. So what were the key takeaways from that, David?
So the results were certainly strong. The NAV total return for the 12 months ending 31st of October was 18.1% versus the FTSE All Shares 16.3%. So you can see there was an outperformance there. Now, the share price total return was slightly lower at 13.2%. But solid enough, again, especially when you kind of consider the 2.7% dividend growth from the previous year, which gives BRIG a 3.9% yield, which is comfortably ahead of the benchmark. Now, performance was helped by managers Adam Avigdori and David Goldman's stock selection in the financial sector. NatWest in particular saw its share price almost double, while we saw some good results from Standard Chartered and the private equity group 3i also contributing. Now, you'll be unsurprised to hear that interest rates staying high for longer has contributed to robust net interest margins for the high street banks. Now, as the name suggests, BRIG, BlackRock Income and Growth looks to balance income and capital growth. So it is encouraging that it was able to do that in the past year. While it might not have the highest yield in the sector, that total return ethos certainly positions it as an attractive option for long-term investors, especially today on a discount of about 15%. And Joe, we also saw results from SEQI. Could you talk us through the key highlights here, please?
Yeah, by way of a quick recap, SEQI invests predominantly in private debt backed by economic infrastructure projects, and that provides a defensive exposure, but with some strong secular growth drivers. So in terms of results, SEQI announced a NAV total return of 5% to the end of September, thanks in part to its steady stream of dividends, which remain cash covered. Annualised returns of 10% have exceeded the 7 to 8% target over the long run, and SEQI's flexibility to tilt the portfolio between fixed and floating rates can create opportunities for alpha generation. One notable development in the results was progress made on the 3 non-performing loans, with one resolved, and good progress on recovering the loan to Bulb Energy. We should also point out that loss rates have been very low over the life of the trust, and that reflects the manager's expertise in recovering and restructuring debt where needed. In terms of pipeline, the managers are bullish. They've identified around £500 million worth of potential investments with an average yield of 10%, so above their gross target range. Moving off results, we also welcomed Chief Executive and CIO Randall Sandstrom onto a recent Trusts in Focus podcast. He spoke about the boom in the private credit market since the global financial crisis, and given its low correlation to bonds and equities, it does offer investors some diversification. Randall also spoke about their risk management process in terms of holding a very diversified portfolio, more than 50 loans across a very wide range of subsectors and geographies, also focusing on lower risk operational rather than construction assets, and also finally the huge need for private capital to plug the investment gap given current public debt levels, and particularly given the infrastructure spend that's needed to meet net zero goals.
Joe, you welcomed Jean Roche, manager of the Schroder UK Mid Cap Fund, onto the Market Matters podcast as well. What were some of the key themes that you discussed?
Yes, so Jean runs the Schroder UK Mid Cap fund and shared some really interesting thoughts on equity markets. One thing we discussed was possible measures to stimulate domestic interest in UK equities. As we know, they've been rather unloved for some time. And apart from removing stamp duty, Jean spoke about showcasing the opportunities in UK equities to generate a little bit of FOMO amongst investors. US equities have stolen the headlines in terms of returns over the last few years, certainly. But as Jean mentioned, the UK has actually had a higher share of multi-baggers in the US, and the FTSE 250 has outperformed the S&P 500 if you look back over the last 25 years. Just moving on to the income front, the FTSE 250 index has been yielding 4%, which is in line with the FTSE 100, so plenty of positives that could close that persistent valuation gap. We also discussed the impact of possible tariffs under Trump 2.0, which have certainly been weighing on equities this week. Jean did point out that tariffs would be applying to goods rather than services, which account for the majority of UK exports to the US, but also that 50% of the FTSE 250's revenue is actually ex-UK in any case, and 20% is generated in the US. So, added to China, Canada, Mexico being in the crosshairs for the first round of tariffs, hopefully it shouldn't have as much of an impact on the UK, but obviously time will tell on that front. And looking ahead, do we start finally to see some normalisation of American exceptionalism? Jean sees a fall in interest rates being positive for UK mid-caps, but the jury is still very much out on whether the US sparkle will start to grace other sectors as we move through 2025. David, you also had a couple of podcasts, so could you talk us through those?
Yeah, so now we are obviously recording this podcast on Monday, the 3rd of February. So we only know the outcome of 2 of the Saba votes that happened this week, both of which just came through before we jumped on this podcast recording. But one that we can certainly talk about is Edinburgh Worldwide, which has its vote on the 14th of February. Now, firstly, obviously, we'd encourage all of our listeners to vote if you're listening to this in time. The voting closes if you're a Fidelity customer on the 7th of February, while Hargreaves Lansdown, AJ Bell and Interactive Investors customers get until the 10th of February. So if you haven't already, do pop on there and give it a vote if you're a shareholder. Now, I've had the chance to hear from 2 of EWI's managers. Svetlana Viteva came on our podcast and Douglas Brody did a webinar for us. You can, as ever, find both on our YouTube page. Now, it was a fascinating spin through their portfolio, which includes some really exciting themes and companies like quantum computing and space exploration, which are always fascinating to hear about. Now, clearly, performance has been challenging over the past 3 years, but it does feel like a portfolio like EWI's can benefit from more American exceptionalism if that is something that continues. And hopefully it may kind of hedge your bets if you do think that American exceptionalism might kind of fade a little bit. This portfolio certainly would give you exposure if you're wrong. Now, it goes without saying that if you're a shareholder, then it's worth listening to both of these podcasts and webinar. But even if you're not, you can learn a lot about the new and innovative areas of the global economy through their explanations of PsiQuantum in quantum computing and SpaceX in space exploration, as well as Alnylam Pharmaceuticals, which is a pharma company, and again, really interesting from that point of view. Now, another podcast I did was with Ashoka White Oak Emerging Markets. Now, we had some quite serendipitous timing with this, actually. Long Lim, the manager, had just got back from trips from South Korea and China. So it's really fascinating to get some on-the-ground insights and perspectives into both those countries, but particularly China. Now, Long is fairly constructive on China moving forward and is hopeful that the struggles that it's been through in recent years will in the end make its companies and capital markets stronger for it. Long also spoke to a focus on small and mid caps within emerging markets, its focus on more democratic countries, as well as the case for less concentrated portfolios, which is something we've also recently written about when it comes to AIE, which is AWEM's Indian stablemate. Now, these investment trusts have 150 plus individual holdings in their portfolios, which is a little bit controversial. But they're certainly channeling Peter Lynch, the famed US investor who ran Fidelity Magellan Fund, with at times hundreds, sometimes thousands of companies within it, and performed superbly.
Thank you. Some very interesting insights there.
And Joe, you recorded a special edition of the Market Matters podcast with Baroness Ros Altmann.
Yes, by way of introduction, Ros sits in the House of Lords and she was also previously Pensions Minister. Ros has been a very keen campaigner for reform of cost disclosure rules for investment trusts and has some very interesting views on the investment trust sector. So I'd highly recommend listening to her podcast, but here's a flavour, a few of the things that we discussed. So no prizes for guessing that Saba was one of the hot topics. Ros's view was that you can't really blame opportunistic investors from pouncing on high discounts and, in her words, the gaping holes in protection for shareholders, where a minority shareholder can take over the board and act in their own interests, not necessarily the interests of other shareholders. But having listened to Saba's most memorable presentation, as we know, Ros felt they clearly didn't understand the nature of closed-ended funds and patient capital, and that was understandable given that hedge funds are by their very nature shorter-term traders. But Ros also believes that there has been a degree of complacency by boards about narrowing discounts, and that the Saba battle, if nothing else, has shone a spotlight on retail platforms not being required to inform investors of upcoming votes, as David's just done earlier. And given the Saba approach, it's very much a contentious topic. On that subject, last week, the AIC wrote a letter to petition the government to require retail platforms to inform investors of votes unless they opt out. So watch this space on that one. Coming back to cost disclosures, Ros spoke about these contributing to the selling pressure on investment trusts that we've seen, and indeed the irony of EU countries not imposing the EU-derived rules in the same way as we were doing in the UK. And this market dysfunction, meaning investors were being misinformed about paying a management fee that they weren't actually paying because it was being borne by the company. Now, while the FCA and Treasury has finally deemed that the current rules aren't suitable, some of the retail platforms have threatened to, or indeed have on certain occasions, deplatformed trusts for showing zero fees. And it seems that some of them may need to invest in new technology to allow this to be shown. Perhaps more controversially, Ros questioned whether there's a potential conflict of interest from platforms earning fees from investors holding OICs rather than investment trusts, and whether this makes their stance on fees a potential contravention of consumer duty regulations. Finally, Ros also spoke about potential reforms to ISAs and pensions, which we've seen a lot of in the financial press, and the UK really been an outlier in terms of providing tax relief for investments made outside the UK, which could, if reversed, potentially unwind the doom loop, as she put it, in UK equities. And on the macro side of things, the need for the Bank of England to start to ease monetary policy and cut rates to kickstart the economy. So as I mentioned earlier, that podcast definitely worth a listen.
And that's it for this month's roundup of investment trust news. If you'd like to find out more on any of the topics we've covered today, head over to the Kepler Trust Intelligence website, and we hope you join us again soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.